Today I'm going to be looking at a couple of different uranium producers and developers in this quick little comparison. So let's hop right into it without wasting any of your time. Hey, my name is Tucker Krause and welcome to my channel, and like I literally just said, we're going to be looking at some uranium producers and developers in today's video. Just doing a very quick comparison between them, nothing too serious. But before we do that, if you haven't seen my video that I just uploaded on Tuesday that goes more over the uranium investing thesis, I would highly recommend you watch that first, then come right back here to come and see some of these comparisons. So without any further ado, let's get into it.
Alright, so I have a list of the companies I'm going to be looking at today pulled up here, and so this is the same list of the popularity comparison I did a couple months back, minus the royalty and exploration companies, but we still have 10 companies here, so that's still a very considerable amount. Another thing to note is that instead of using some of their higher volume Toronto exchanges for companies such as Global Atomic, I used over-the-counter to avoid any mess-ups with conversion between Canadian and US dollars, and we can have everything as they are trading exactly. So, of course, first up, just going from largest to smallest market cap, we have Cameco, then NexGen, then Denison, then Energy Fuels, then UEC, then Global Atomic, then Fission Uranium, then UR Energy, then enCore Energy, and followed by Forsys Metals. And so we can see that none of these companies are profitable at this moment, of course. That's why there's so much growth potential for lots of these uranium companies, or at least part of it. And we can see that none of them pay a dividend, except for Cameco, but that makes sense. They're all very small companies, let alone unprofitable small companies at this moment, at least. And so, of course, they're not going to be paying a dividend. Now, the other thing I want to quickly touch on is their share price. I kind of prefer when the share price is higher because it means they aren't diluting shareholders quite as much, which was done during the bear market to help these companies survive compared to taking on additional debt. But we can see companies like Denison have cheaper share price than a lot of the companies smaller than them, showing that they diluted their shares more, which I'm not as big of a fan of. I'm not a huge fan of companies diluting their shares extra, but of course it was that or take on debt, so that's not too important either way. Share price doesn't really matter too much. Last thing I want to touch on is, of course, market cap. It's a lot easier to push up these smaller market cap ones, so they have a lot more potential for explosive growth compared to, say, Cameco, but Cameco's also far safer since, of course, they are currently a producer. But without wasting any more time, let's hop into the first metric I'm going to look at. First thing I'm going to be looking at is their price to book ratio, since of course they don't really have, earnings, in some cases, let alone revenue, but I'm going to be still wanting to take some kind of comparison metric, though this isn't the only one, of course. So price to book ratio we can see here. Of course, if it's less than 1, it's generally going to be undervalued, but of course you want to look at other metrics. And book values, of course, total assets minus intangible assets and liabilities, and kind of shows us what the company would be worth if liquidated. And so, first place we have Fission Uranium, with actually the only company here with a price to book ratio below 1, which is quite impressive, though of course you want to look into see a bit more behind that since it's a basic metric, but of course this video is not ending right now, so of course we will. But again, so we can then look, okay, Cameco here in second, but not too far behind, and then we start to see a substantial drop off by the time we get to Denison and UEC, especially by the time we start to get to Energy Fuels, NexGen, and the rest of these companies down here. They start to get decently pricey, but we can still see substantially good for Fission Uranium and to a bit lesser extent for Cameco here. Next up, I'm going to be looking at each of these companies' deposit or total of their deposit size, but of course I'll only be looking at that company's share for shared deposits, and because you might say this is a market cap comparison, not really, because we see some companies that had a smaller market cap have risen up in the rankings for their deposit size, such as Global Atomic is in 4th place here, whereas we can see they were actually only the 6th largest by market cap. But more importantly, it's because larger deposits help, because say a energy supplier may only want to go to a single company for its uranium needs, so it's much easier to go to a company that has a ton of uranium. But we can see here, of course, Cameco is in first. This is all still relatively close to their market cap, but there are some changes, like I noted with Global Atomic, and so we can see they do have quite a bit of size difference here, with Cameco followed by NexGen, then Denison, then Global Atomic, then Fission Uranium, then Energy Fuels, then enCore Energy, then UEC, then Forsys Metals, followed by UR Energy, with a substantially smaller deposit than even 9th place's Forsys Metals. Though, to be entirely fair, why a company like Global Atomic had a larger uranium deposit size than UEC despite having a smaller market cap, UEC also has way more exploration projects and different things like that. Though at the same time, Global Atomic also has its zinc processing plant. That you could say that example for all these different companies. So of course this isn't the be-all end-all of this company's assets. You often have extra exploration and different processing plants and whatnot on the side. Alright, so price per pound, you can think of this as similar to a PE ratio, but using their deposit size instead of their earnings. But we can see, of course, I forgot to mention this earlier, this is as of their most recent presentation, or whatever the overview on their company website says, since I don't have time to read through tons of technical reports and annual reports and things like that. But we can see here that we have first place Global Atomic, followed closely by Forsys Metals, with a larger drop-off when you got to enCore and Fission, with a big drop-off when you go down to Denison, UR Energy, UEC, NexGen, and Energy Fuels. And then you see a massive premium for Cameco, but that's likely a producer premium. And so we can see that, in general, it looks like this way Cameco is very, very pricey. Same thing with Energy Fuels and NexGen and UEC, but by the time you get to UR Energy, Denison, it's okay. But by the time you get to these top four here, it doesn't seem like you're actually paying too much, at least relative to these other companies, since this is still a fairly small sample size. So of course, in the comment section, let me know if you'd like me to do this again with some other companies. So now I just want to touch on their deposits grades. As you can see here, I averaged out some of their deposits for Cameco and all the deposits for all these companies that have multiple. That's why Denison, it only shows a 7.09 parts per 100 grade, since of course some of their mines have substantially higher grades than that. Of course, lots of the high grade ones here are in the Athabasca Basin, and the lower grade ones can be helped by using ISR or other alternative methods and that sort of thing. So that doesn't mean it's all bad for some of these companies that are lower on the list, because I also wasn't able to, so don't click off yet, this is important, I wasn't able to get CapEx or to start up the operation, or OPEX or AISC or that kind of thing, because different companies would list different things on their overviews and presentations, and so I wasn't able to find anything that just lined up between every company, since I obviously don't have the time to look through, multiple technical reports for every single one of these companies, every single one of their deposits. So when we move on to total score, note that this isn't everything. This doesn't include CapEx or OPEX or AISC or whichever numbers you want to use there. And so we can see Denison in first, followed closely by Fission Uranium, which is a surprise because they never really, other than price to book, came in first. They were always kind of in that 4th to 5th place, consistently high, followed by Cameco, then Global Atomic, then NexGen, then enCore, then Energy Fuels, then UEC, then Forsys Metals, and UR Energy. So the main problem there is that this doesn't show us the efficiency and the operating costs of each company. This only shows the deposit itself, not how good these companies are at getting it out of the ground and for what cost, which is of course a major part of it. So this isn't a be-all end-all ranking, because of course you need to know how these companies can get it out of the ground for what price. And when I want to invest in uranium, I'd like to know a bit more in depth, and I'd also like to put out content you guys would like to see. So comment down below which of these companies you'd like me to look further in depth to, because I don't mind looking through just a couple technical reports compared to, maybe a few dozen, because you're looking through multiple per company. So without further ado, thanks for watching, smash that like button, and I will see you next time.